Welcome to Coverage and Clarity with Jacques, the podcast where we break down protection, planning, and peace of mind so you can make confident decisions for the people who matter most.
Welcome to Coverage and Clarity with Jacques. This is where we slow things down, remove the confusion, and focus on what truly matters, protecting the people you love with confidence and understanding. Now, today I want to share with you the top 20 life insurance mistakes you must avoid. Far too often, I see the following items, which I'm going to discuss with you today. I want to show you how to avoid them, and this will make all the difference for you and your family. Now, to do this, I want to explain to you in 4 distinct sections. Section 1, getting started the right way. What is the primary reason for looking into getting coverage for yourself? Section 2 will go over the details that matter most, how to get the most out of your existing policies. Section 3, understanding your policies, knowing the details of what makes it work. And finally, the long-term protection and planning, making sure your policies work as intended. Now, getting started the right way. With this one, the first mistake I want to go over with you is waiting too long to buy. Now, as you may know, premiums increase with age and health issues. So the younger you are, the cheaper it is for you. Now, some people may say, oh, I'm too young to get life insurance right now. Well, as long as you're over 15 days old, you're eligible to get a life insurance policy for yourself. So at that point, your parents would basically be the ones getting it for you. But at 15 days old or older, you are of age to get a life insurance policy. And of course, the younger you are, there's no health issues. So while you're young and healthy, you get the best rates for all the reasons. The age, being that your health is in good shape, and then there's nothing that you have to take medications for. So the earlier you start, the more options you have. Now, some people will wait until they're later on in years. Now, what happens, let's say you want to get a term policy later on, you cannot be eligible for a 30-year policy because you may have up to 30 years for a term policy, but as you get older, they're not going to give you that full 30 years. Because with most term policies, they usually stop adding up by age 80. So if you already have it past that age, that's one thing, but you cannot get it to have another 30 years from an older age. So this is the reason why you want to get it as early as possible. Now, assuming that you're too healthy or you're too young, like as I mentioned, as long as you're 15 days old, you're old enough. And too healthy, well, that's the reason why you want to get it now. Because once you start getting things such as diabetes, high blood pressures, and many of the other conditions that people have, it's going to make it harder for you to get. No, it's not going to disqualify you, but what's going to do is make it a little difficult depending on the companies that you go with. Now, remember, I'm an independent broker working with over 40 different carriers. So for me, regardless of what health conditions you may have, I have a policy for you because I've known which ones will take which conditions. That's the advantage of working with an independent agent such as myself. And that is why I started doing that as an independent agent. Because when I worked with specific companies, you're tied to their one product. Now, if a client does not fall into that category for that product, there's nothing you could do for them. Right now, if you fall into a category and we're not able to get you a policy with one particular carrier, I could go over to another one. So I'm 99% sure that anyone that I meet with, there's a policy out there for you. The question is, let's find the right policy. So that's why I always say, talk to somebody such as myself, who's an independent broker and works with multiple carriers. Now, the third mistake a lot of people make is buying on price alone. The cheapest isn't always the best for you. As you know, you get what you pay for. Now, if it's cheap because you got it early, that's one thing. But if you are 60 years old and someone tells you I have a $2 policy for you, you know that $2 policy is not going to work. So as you know, you have to get what fits within your budget, within your age range, and within the categories that you're looking for, whether it be a term or a whole life policy, a permanent policy, or a temporary policy. Now, you may say, what's a temporary policy? Well, let's say you buy a house and you have a 30-year mortgage on there. You want to make sure that in the event that you're no longer around, that mortgage is paid for. So therefore, you would take a 30-year term policy that covers the same period as the loan of the house. So if one or the other person should pass, at least the house is paid for and the rest of the family could maintain living there with the paid up house. So that is the reason why I always say the earlier you get it, the better it is. And you get for what you need. Now, affordability is important, but remember, once you know your pricing, you could put into your budget. Once it's in your budget, your life insurance is one of the first things that needs to be covered. So basically, your roofing, your housing, whether it be your mortgage or rent, your life insurance, and of course, your vehicle if you need to get around from place to place. Once those are covered, everything else could fit in around those budgets because that's your main priority, is to protect you and your family. Now, the fourth mistake people have is not having enough coverage. Now, they may have started off with a policy, whether it be 50,000, 100,000, or whatever the amount is. But at the time they got it, that was sufficient for them. As time goes on, you have to protect your income, the stability of your family, and any future plans. So as you have additional children, as you get a mortgage, as things change in life, you want to make sure that you have enough coverage to cover the expenses in the event that you're no longer there, so that you protect your family. Because remember, life insurance is there not just for you, but for your family. Now, this is the biggest one, mistake number five. People who rely solely on employer-provided coverage. Now, many jobs do cover you while you're working. That is true. But here's the thing. The day you leave that job, you no longer have any coverage at all. You'll be surprised how many people I speak to who are in their 40s, 50s, 60s and says all they have is their employer-provided coverage. Well, if for whatever reason that job should stop, whether you retire, you leave the job freely, or they tell you that you're gone, your coverage is also gone. And what happens is the older you are, if you have any health conditions, that's going to make it that much harder and more costly for you to get a policy. So I always tell people, get it as early as you can. Keep your employer provided coverage as additional coverage, but I hope that you pass on well past the point that you're working so that that will no longer be necessary for you. But in the event a person should pass during their working years and they have employer provided coverage, at least the family will have additional coverage to protect themselves. Now, the next section, details that matter the most. Now, mistake number six is letting policies lapse. Now, policies could lapse for a number of reasons. For non-payment, you may have forgotten about it and then, let it go past and everything else. Well, those are the reasons that you need to make sure your policies you do not lose your policies because of lapsing. Because first of all, when you've had a policy like a whole life policy, for instance, or any permanent policies for a while, you've built cash value into there. So basically, by letting the policy lapse, you lose out on all that coverage, all the cash value that was built into it, as well as the actual insurance coverage. You want to make sure that you still have those in place. Don't miss any premium payments because by missing the premium payments, your policy will lapse. Now, if you have protection on there where the cash value will pay for any missed payments, that is fine. But eventually, that must be paid back. And eventually, if you don't cover new premiums, that eventually will make your policy lapse. So basically, make sure payments are always made into your policies no matter what, because you worked too hard to get it and you got it at the best rate. Because whatever age you were before you got it, is going to be much cheaper than what age you are later on to get the same amount of coverage to replace that. Mistake number seven, not reviewing the beneficiaries after life change. Now remember, after things happen, so for instance, you get a life policy when you're young, in your 20s, maybe right out of college. From there, the only reason why you would basically need it is to make sure that in the event you pass, your student loans are taken care of. Now, later on, you meet your spouse and you get married. Now you have two people to worry about. You want to make sure you have additional coverage to cover both of you for all expenses that may be there. Time goes on again, you now have a family, whether it be the first child, second child, third child. But as you have more children, there's more responsibility and more things you need to cover in the event you're no longer there. So this is why you need to review your beneficiaries at each life stage so that no matter what, you know who you could count on for there. If the person that you had originally is no longer around, or maybe of too old to take care, let's say, of the children, if you were to leave money to them for that purpose, you want to make sure that the beneficiary is someone who you could count on. Your coverage should reflect your current reality, being if you were younger and you had a parent as your beneficiary, in the case of you passing, that's understandable. But when your parents are now in their 80s and 90s, you need to have a person that you could count on in the event you're no longer there to take care of the proceeds from your policy. Now, mistake number 8 is choosing the wrong policy type. Now, many people don't understand the difference between a term policy and a permanent policy. Well, let me break it down very simple for you. A term, just like the name states, is for a period. It could be 10 years, 20 years, or 30 years. Now, some companies will go as far as 40, but that's far and few in between. But it's a specific time period that you're being covered for. That's basically used for in the earlier years, maybe when money is tight, but you need the protection, you at least have something to cover you. With a term policy, there's no cash value in there. So many people say, oh, only 2% paid out and the other 90% didn't pay, so they wasted their money. No. The good thing with the 98%, that means that they survive past the period of the term. The 2% that paid out were people who passed away. So maybe their family was covered. In that sense, it was good that they had it, but for them, they're now gone. So we want to make sure that you're around as long as possible. This is where your permanent policies come into play. With your permanent policies, you build cash value over time. Now, with that cash value, you can do a number of things. As I mentioned earlier, to prevent your policy from lapsing, the cash value could pay into the policy for you once you reach a certain period of having the policy. What that will do is prevent it from lapsing. So that's one benefit of having a permanent policy. The second benefit of having a permanent policy, you could borrow the cash that's in there. It's like you becoming your own bank. So that's another term for that is called infinite banking. So with that, you use the funds that you build into your policy to manage for yourself. Now, of course, it depends how much money you have in there. But the fact is, if you do borrow money from there, you pay back with interest as you would normally do, but there's no credit check on there. So here you're actually funding your own financing for the loan that you take against your policy. But remember, if you have a loan outstanding and a person should pass, that amount is deducted from whatever the death benefit is. So in that case, your beneficiaries will have less coverage that's paid out to them because of the fact that you took money out. So always remember, if you ever use the cash value, make sure you pay it back because by paying it back, you're protecting your loved ones. Also, with the cash value, as you get older, maybe you won't need as much to protect you because you've had it for so long, it built a substantial amount in there. At this point, you could take out a portion of the money, which is all yours, and now you have that to do as you please, and whatever is left in there will be the death benefit upon your passing. So as you can see, with a permanent policy, you have a lot of choices of what you could do with it. Now, remember, all the different types of policies out there is term, whole life, universal life. All of these policies, as I mentioned, each have their own specific purpose outside of the death benefit. The death benefit, of course, covers that specifically, but what you do with the policy while you're alive, that will all depend on which one of these is the best for you. Now, forgetting to update your contact information, mistake number 9. If you do that, insurance cannot reach you. So if there's anything important for your policy, whether it be policy dividends, if payments are needed, if something has changed with the agent that maybe provided for you, or whatever other communication insurance company needs, they won't be able to reach you. So you always want to make sure that your contact information is up to date. For me personally, with all my clients, I do annual reviews with them. That's one of the purposes of doing the annual review. Even if they don't buy anything new on the follow-up, at least I make sure that the information is updated and provided to the insurance company so that in the event of anything, whether it be a passing or any other correspondence that's necessary, the insurance company could contact the client directly. Nowadays, also, we can do things online. Many carriers allow you to set up an online account. So that's another way that you could make contact with them. Now, the next mistake many people do is naming a minor child as a beneficiary. Now, as you know, anyone under 18 cannot enter into any legal contract. So listing a minor child is the worst thing that anybody could do. This will create legal complications. Because in the event you should pass and the child is the only one who's the beneficiary, they cannot collect. So what I always tell my clients, find someone else that you could use who's of majority age, over 18. But in the event you do want to put a child there, what you could do is use a trust instead. Now, in a trust, it will state all the conditions to pay out to the child. Let's say you put in there that the child must be over 21 before any payments received. That is fine. If the person should pass and the child is still a minor, the money will remain in there and collect interest for the child upon his or her age 21. At that time, it'll go right to the child, and then they will have the proceeds at that time because they're of age, and hopefully by age 21, they know what to do with the money and they don't squander the money. You always want to make sure whoever you leave the funds to know how to take care of the money. More importantly, for your funeral. Outside of that, so that they're not out there to blow the money that you worked so hard to provide for them. So the trust is always another good way to put your money because in here you'll be able to make sure it works the way you planned it, regardless of the situation. Now, if you found the advice I've given to you so far helpful and would like to inquire more about coverage, call or text the studio at 631 594 8118. Once again, that is 631 594 8118. Okay, now let's continue with the next part that we were discussing, understanding your policy. Mistake number 11, not being truthful on the application. Now, you know, you always have to be truthful with a legal document because that is considered perjury, basically, if it goes to the court of law. Now, honesty ensures your policy will work exactly as intended. You do not want your policy voided because you lied on the application, and that is the option that the insurance company took, was to void out your application. Now, some people may say, oh, they smoke, but they don't want to put it down. All that's in your medical records. Now, through the Milliner report and through your MIB, all that's already in there. So it's not worth lying about. If you do smoke, you pay the little addition that you have because you're a smoker. But the best thing to do is to stop smoking so that you can go back to having a non-smoker rate. Now, misrepresentation, as I said, for any health or life policy could void the policy, as I mentioned earlier. So on an earlier broadcast, I also mentioned that anyone who knowingly presents a false statement to an insurance application, whether it be life, auto, or any other insurance, is guilty of a criminal offense subject to penalties of their particular states. And that could lead to jail time. It's not worth going to jail just to save a dollar or two here on a policy. Be honest and truthful on there so you have no problems. Now, mistake number 12, believing life insurance is only pays at death. That is the misconception. Now, on a term policy, yes, that is the case. It only pays upon death. But on the other permanent policies, you have many other options available to you. For instance, your accelerated death benefit rider. What that is, if a doctor says that you have less than a year to live, you can get up to 50% upfront of your death benefit, and then you could use the rest for whatever is necessary. So in other words, the 50% that's not used goes towards the death claim that goes to your beneficiary, and the other 50% you could use while you're alive. Whether you want to use this to maybe pay some bills, take some time away with the family, or know that here's something that you could do before your time comes because of the fact you have a terminal illness, now you could do that. If cash value withdrawals, as I mentioned before, you can use the cash values for whatever you need to, whether it be to take loans out, whether you want to borrow against it, take it out totally, or use for any other purpose. Now, the policy loans, as I mentioned, you have an interest that you pay back on it, but there's no credit check and it's your money, so it's guaranteed to you. So these are the reasons why having a permanent policy is always a good thing to have. Even if you do have a term policy out there, always get another form of permanent policies to add to it to make sure that you're fully protected no matter what. Mistake number 13 is never reviewing your policy. Now, as you know, life does not stand still, so your insurance should not stand still either. As your life evolves, your coverage should also. As I mentioned, in your earlier years, you may have gotten life insurance to protect your student loans, as an example. Once you get married, you have a spouse that you want to make sure you're responsible for. Once you have children, you have additional people in your life that you want to make sure you're responsible for. So these are all reasons why you want to review your life insurance policies. So as these changes occur in your life, you could add that on. Now, your life insurance policy is a living part of your financial plan. The same way you schedule your annual health reviews, you should also schedule your annual insurance reviews. Now, as I mentioned to you before, I personally schedule with all my clients every single year. I talk to them at their birthdays, other holidays I speak to them, and of course, upon the anniversary of the writing of the applications, I make contact with them. So at any given time, you could always update your policies for anything that may change in your life. Look at the total death benefit that you have on all your policies. Do they meet your family's needs? As I mentioned, as you have more responsibility, more children, or even if you got divorced and then things change, you want to make sure that the death benefit that you have is sufficient to carry on upon your demise. Now, if you have a term policy, you want to review it because when does the term expire? Now, you may say, oh, I have a 30-year term. That's a long time from now. You'd be surprised how quickly 30 years could go. So now if you're at the end of that and you want to renew that for an additional period, you're now 30 years older. What does that mean? Policy is going to be more expensive. This is why no matter what term policies you have, you want to make sure you add a whole life or another form of permanent policy in addition, so that when a term does expire, you have some coverage that's going to remain with you for the rest of your life. Now, people may wonder what would warrant a policy review. So, as I mentioned before, getting married, welcoming a child, buying a house, a new job or promotion, or paying off debt, or children leaving the home, all opportunities for review. Because with all of these, your circumstances change, meaning that the amount of money that you would leave or not leave will change. It either go up or go down. So this is why you want to review your policy every year to make sure that what you have is what's necessary for that part of your life. Now, mistake number 4 is choosing the wrong beneficiary structures. Now, many people don't understand the difference between a primary and a contingency beneficiary. So let me explain that to you specifically. Your primary beneficiary is who will get the proceeds upon your demise, whether it be a parent, a spouse, a child, or another relative. Or some people may even leave it to a charity. So no matter who that may be, the primary beneficiary is who gets the money upon your demise. Now, in the event that they should pass on before you pass on, you have a contingent beneficiary. Now, the contingent beneficiary is any secondary person. If, for instance, you had your sibling as your primary, their children, your nieces and nephews could be the contingent. If you had one person as your primary, the contingent could be a different person. So no matter what, you know that upon your demise, the money will go to the primary or secondary person to make sure that your wishes are carried out, which is normally for your funeral, and then anything else that you leave to them after that's all paid off. Mistake number 15, and this is a big one. People think that coverage is only for the income earner. So whether you have a husband who's a stay-at-home husband, a wife who's a stay-at-home wife, or a person who's lived by themselves, whoever that may be, the caregiver needs to have just as much protection as the person going out there and working. Because if the caregiver is not there, the other partner has to replace the income that we needed to cover taking care of the children, for instance, cover the home, cover the needs that the other person took care of. So just because you're not an income earner doesn't mean that you don't need life insurance, because your life is just as valuable as the other person's life. You want to make sure that no matter what happens, whether it's the income earner who passes, the provider who passes, that the children are protected because all the needs are taken care of, not only financial, but all the everyday needs. A roof over their head, food on the table, clothes on their back, etc. So these are all reasons why you want to make sure that all parties have insurance on their lives. Now, the next section, the long-term protection and planning. Now, with this one, the first one is buying without guidance. That's number 16 mistake. Life insurance is personal. Clarity matters. You need a professional such as myself who explain to you all the options available. So don't just buy a policy just for the sake of buying a policy. You want to have it with guidance. What is the purpose? Is it to leave for your children in the event you're no longer there? Is it to pay off your mortgage? Is it to leave to a charity? Is it to make sure that there's income provided for the home? Always look at everything before buying the policies. Make sure, number one, that you can afford it in your budget with your other expenses, whether it be other policies or your other everyday expenses. You want to make sure that whatever policy you get, it fits in your budget and it works for you. Now, ignoring the final expense planning, mistake number 17. Now, you don't want the funeral costs to become a burden. Have some sort of insurance protection. Not just what you have on a job, but have something for yourself as well. Too many people rely on GoFundMe. Now, what people do not realize with GoFundMe, there's a percentage that goes to the company. It's not done for free. Remember, it's a for-profit company. But this should not be the way to pay for your funeral. You came into the world with dignity, you want to leave the world with dignity. No one tries to take a collection to make sure that you're put into the ground or cremated or whatever your choosing is in terms of your disposal after you pass. You want to make sure it's taken care of, it's provided for, and there's no debt left to your family or anybody else for for this purpose. So remember, protect what you need to make sure GoFundMe or any other crowdfunding source is not needed to do a funeral for a person. Because another reason also, people may say, okay, I want to raise the funds, but now it takes time to do that, whether it be 2 weeks, 3 weeks, 4 weeks. The longer you're there, the more expensive it's becoming anyway. So have it done properly the first time. Have the money available for you upon your passing. Mistake number 18, assuming health challenges means no options. Now, remember I mentioned I work with over 40 of the top A-rated companies out there. No matter the health condition, I have a policy for everybody. So sitting down with me, I'll review what's there. We'll take the application together in person. And if it doesn't work out for whatever reason, we always have a backup to go to. I want to make sure that no matter your health, you have a policy for yourself. And just because you do have a health condition, whether it be a heart condition, diabetes, or any other health condition, you're still eligible for it. The questions they ask you is not to disqualify you from there, but just to get a better understanding. Remember, these are all the reasons, all the ways that the company looks into getting the pricing for the policy and the amount of coverage that they give you. The worst that could happen is that they'll either give you less coverage for the amount that you wanted or charge you a premium to keep the amount that you wanted. But either way, they will know that once they know your health challenges that you may have. So the earlier you get it, when there's no health issues, that is the best time to get it because the younger you get it, the cheaper it is, and the healthier you are. Mistake number 19, not coordinating life insurance with estate planning. Now, I provide to all my clients what I call the family data guide. The family data guide has everything broken down for them. It lists who they are, who their spouses are, any information such as the socials, because remember, upon a passing, they're going to want to know the social and the person's parents' mother's maiden name. So these are all stuff that's on the family data guide. For those who served in the military, it has the data information for the military because with the military, there's additional benefits that they get. And for all those people who have served, who are clients of mine, I always thank them because without them putting their lives um, out there for us, we would not be sitting here today having this conversation. The next section of the family data guide that I provide talks about what bank accounts you have. Now, some people may have that secret bank account or, the holiday fund bank account, etc. Now, if it's a secret or holiday fund, people are not going to know about it. If you should pass and no one knows about it, what happens to that? It goes to the state. Now, I always say whether it's $1 or $1 million, your money should go first to you, and if not to you, to who you choose to. Not leaving to the state or anybody else unless that was your choosing. So I always tell people, whoever you trust to have this information, you let them know where all the bank accounts are and the approximate amounts in them. Now, of course, the amounts are going to change, but at least they know what amounts will be in which account. Once you have that, if anything should happen, that's given to them and they know where to find it. Because the worst thing that happens is a person passes and no one know and the insurance company does not know that that happened. That money will eventually go to the state as well. So on the financial portion, you want to make sure whether it be a bank account, investment account, life insurance, that all that is clearly listed to whoever you depend on. And that person, as you know, we call the executor, the person who's responsible for you. So you want to make sure that he or she knows where to find it. The next section on the family information guide um, is how do you want to be remembered upon your funeral? Do you want to have a church service, a funeral home service, or graveyard service? Do you want to be shipped to another state, another country? Do you want to leave anything specifically to be done for you at the time of your passing? These are all the stuff that's on the family information guide. What I tell people once they finish filling it out and they know that the executor knows where it is, sign, date, and more importantly, have it notarized. By having it notarized, it becomes a legal document. Now, with that, you can put with the next portion that I'm about to talk to right now, the last will and testament. Now, in a previous episode, I went through the exact things that's in the last will and testament. Well, once you have the last will and testament and the family data guide, you make sure both of them are notarized and signed, and you put them together so that your executor knows where to find it. Upon your passing, make sure the executor files it with the state the day after so that nothing goes to probate. Now, probate is when a person passes and the courts decide what happens with the assets. You want to make sure this is all clearly listed out up front. Now, the last thing I want to go over with you is treating your life insurance as a one-time decision. Now, protection should be reviewed as life changes. I mentioned that multiple times already in this episode. As you get older, more responsibilities come, responsibilities change. You want to make sure that your life insurance matches those. So that, therefore, as you need more coverage, you have that. As things change in life and you need to decrease it, such as paying off your mortgage, you could now change that as well. So these are all things that you want to do to make sure that everything's taken care of and it's not treated as a one-time decision. You have it in your earlier years, you have it in your working years, and then you have it again in your retirement years. So those are all the mistakes that I've seen. These are just all the mistakes, but these are most of the biggest mistakes that I've seen that I want to make sure you do not do for yourself, which is why I'm explaining that to you today. Now, here's what I want you to remember. Life insurance isn't about fear. It's about foresight. It's about making a thoughtful decision today that brings peace of mind tomorrow. Now, that's what we focus on here at Courage and Clarity with Jacques. Education, understanding, and protection you can trust. Now, if you find out things that I mentioned to you in this podcast as a valuable to you, please share it with someone else who you care about. And if you're unsure whether the current coverage you have truly fits your life, I'm here to help you every step of the way. Now remember, I provide coverage to clients nationwide. If you want to contact me directly, you call or text the studio line at 631 594 8118. 631 594 8118. Now, this is Coverage and Clarity with Jacques, where protection meets understanding. Until next time.